Good afternoon and welcome to the Sondrel Holdings PLC introductory presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Graham Curran, CEO. Good afternoon, sir.
Good afternoon. Welcome, everybody. Thank you for joining us today. My name is Graham Curran. I'm the founder and CEO at Sondrel. I'm an engineer by background. I spent my whole life in designing chips and getting them into production, and I've worked for British companies and American companies in the hardware and also in the software world. Founded Sondrel 20 years ago, with an intention of growing as an international business, which we've done very successfully over the last 20 years.
Good afternoon. My name's Joe Lopez. I'm the Chief Financial Officer. I'm a chartered accountant, over 25 years experience working primarily in international technology and engineering groups. I've been a CFO for nearly 15 years now, which about half of that time has been spent managing fast-growing businesses. So when I met Graham 4 years ago and he explained the transition to the ASIC journey that Sondrel's making, I could see the potential for huge growth, and I joined the company 3.5 years ago.
Okay, so introduce a little bit about us. So we are a fabless semiconductor company. That is, we're a company that designs chips for customers at their specific requirements, and then has those produced and ships the products to the customers for inclusion into their systems. Our customers are typically companies that are making things like mobile phones, cars, PlayStation you'll see on the bottom, things like that, and they want to differentiate their products by having a chip which is designed, which is going to be different from something that they could obtain as a general product on the general market. So they will come to us with a particular need, and I'll talk you through that engagement cycle in a minute. So as you know, we raised £20 million on our IPO just over a week ago, which we were very pleased by. We are very well supported through the whole manufacturing process, and are one of the very few companies able to supply designs and supply chips in the newest technologies, and that means today technology is down to about 5 or 3 nanometers. We are able to source our chips from all the major foundries. We are the only company that has strong agreements and approvals from the 3 primary foundries operating at these technologies, that is Global Foundries, Samsung and TSMC. It puts us into a unique position in being able to offer our customers a choice of any of the foundries, and even being able to offer things like TSMC or Samsung, which are big endorsements of our capabilities, is very rare. We also work very closely with ARM and with a number of other third-party providers, in particular with ARM, who we work who we've known for a very long time. Our engagement, so what we design is what you can see a picture of on the left. These are large, complicated designs in new technologies. And if I look at our engagement with the customers, which you'll see on the right-hand side, and we start here at number 1, typically with a discussion with the customer about what they're trying to do. And that will be a discussion about the system that they have, the type of specification that they're looking to do, the performance that they want, typically in things like the power, the cost of the device, and so on, and where they want to go with that. And we will engage in that specification, architectural exploration, and design phase with them under contract. And that whole contract engagement is going to take somewhere in the region of 18 months. And they will pay us for that engagement. It will be profitable. Fees charged range somewhere between £5 and £20 million for one design, very much depending on the complexity of the design. At the end of that stage, we then move into a prototyping stage, which is the second segment on the pie chart on the right-hand side, and that takes somewhere up to about 6 months, And again, the customers will pay us for that. And we will subcontract the wafer manufacture and the silicon manufacture. We will subcontract the packaging, we'll subcontract the testing, and the other engineering functions that are needed to produce a prototype. And we'll provide back to the customer at the end of that period a fully packaged device that you can see held between someone's fingers in number 6. And over that period of 6 months, the customers will pay, as I say, somewhere around about £10 million for that. Again, it's cash flow positive and it's profitable throughout that period. We'll help the customer integrate that prototype into his systems product, and then the production parts will be bought from us over a period of 3 to 10 years, and with a total value of £100 million or even more in some cases, very much depending on the type of projects that we're engaged in. So that's the full engagement life cycle with a specific customer for a specific project. Obviously, we are looking to engage with customers over multiple projects and multiple lifetimes, and that's where we have a lot of our repeat business. The way we design a chip, these are very, very complicated products. They consist of maybe as many as 50 billion base elements. So we assemble 50 billion transistors onto a chip. Let's say a transistor is the basic semiconductor switching element. But we do that at a number of levels of abstraction in different ways. So we will buy in constituent components from third parties. For example, we might buy microprocessors from ARM and integrate them onto a single piece of silicon. We might buy GPUs from somebody such as Imagination Technologies and lots of other basic building blocks, quite complicated building blocks, I have to say, and we will integrate those. We will also use some of our own customizable intellectual property, some of our own building blocks. They will be typically for more standard functions that we will use. We will save those between different projects so that we can reuse them. And we will also quite likely design some specific functions for the customer's application area, and this can be quite differentiating for them. So with that mix of different approaches, we will assemble a full chip into a system. We will typically place that upon what we call a platform. So that's a way of speeding up and making more reliable the whole integration structure and making sure that we have a higher quality product. And then through into production, you'll see the types of products that we are typically designing into on the right-hand side. And one of the things about these is they tend to be quite high-value products, often in high volumes as well. So you might see a video camera, for example, that will retail at $10,000+ when the chip that we've designed inside, which is the enabling technology, might sell for $50. So very high-value items. We've been around now for 20 years, as I say. We started off as a design services company working in just one of the engineering disciplines, and across the top of this slide, you'll see a number of the different technical capabilities that are needed to design a chip. And over the first sort of 10 or 15 years, we built up a wider and wider capability until we were able to provide the whole engineering capability to design a chip. We also started to provide consulting services into the production aspects, so things like design for manufacture, production engineering, and so on, and established ourselves and our credibility in the whole engineering world across the full lifetime of the product cycle. And then about 5 years ago, we decided to expand further and actually take the contractual and commercial responsibility for the production items. So we then started to build in the relationships and the contracts with the suppliers, people like the foundries, the packaging houses, the test houses, all the other people at specialist, very high value systems and companies that we need to use to outsource parts of the production cycle. And then about 3 years ago, we started to win our first customers in that part. And Joe, in a minute, will talk more about the life cycle of the products and where we are as we move towards expanding our commercial area very strongly. Along the bottom, you'll see some of the milestones in our expansion. We've always been an international company. Our first customer was in Germany. Our first major customer was in Germany. But we opened a design center in China back in 2008, in Morocco in 2015, and we have a number of design centers throughout the world. So we have one in China, one in India, one in Morocco, and 2 in the UK. And that gives us a good balance of cost base, access to good engineers, and the ability to hire engineers to expand, and also to access contracting, consulting companies ourselves to outsource when we need to effectively, whilst maintaining not too many centers so that we manage the communication between them. Here we talk a little bit about the types of application areas we work into. As I mentioned already, we work on the newer processes, on the more complicated designs. And that is very often, the requirements for those are very often driven by companies that are doing some sort of an image processing or moving very large amounts of data around. And to a certain extent, it's the same thing. That the applications that are most in demand of those types of things, requirements today, are automotive, particularly for autonomous driving capabilities. So everything from adaptive cruise control through to fully autonomous driving. Things like augmented reality, virtual reality, a lot of video displays, video cameras, video processing, a lot of image recognition. And this can be anything from visual images through to LiDAR or radar generated images. And then in data centers, we're looking at high performance computing functions, a lot of artificial intelligence, image recognition functions again. Also things like data switches, where again, we are moving very high volumes of data around and trying to do it as efficiently as possible. And then a final area we tend to get quite heavily involved is anything around the sort of security, high reliability aspects. And again, this crosses over with some of the others. So high reliability, for example, for automotive, or for space applications as well. And high security, again, goes into particularly things like automotive, data centers, and so on. So there's a big crossover. Those are the primary areas. If we look at our sales pipeline today, then about a third of our business is projected to come from automotive and about a third in the sort of machine learning, high performance compute areas, with about a sixth in communications. We have a very strong sales pipeline right now. Our sales pipeline is in excess of £300 million in value, and in that value is only including the first two segments on that pie chart. So that's just the design and the prototyping stages. Our workforce, of course, is extremely important to us. So we have around about 150 engineers based, as I said, in 5 design centres, 2 in the UK, across the world. We have an HR team supporting those, and also a training team supporting those. Hiring good engineers is always difficult. It always has been difficult, and hiring and maintaining them is very important. So having structured programs, structured training programs, structured career development programs is something that we pay a lot of attention to. We have our own internal hiring team focused on finding key positions, and we put a lot of attention into identifying and providing fast career paths for the highest achievers. The work that we offer our engineers is very varied. We are one of a very small number of companies that is operating these new technologies, and that makes it a good working environment and a very motivating working environment for our engineers. If I just talk about the market that we're selling into for a minute. So the semiconductor market, although it's taking a little bit of a downturn this year, is around about $680 billion. It's exhibited very strong growth over the last couple of years. No doubt that is going to relax a little bit this year and then continue to grow again in 2024. It's forecast to grow at around about 9% per year and reaching in the order of $1 trillion by the end of this decade. Out of that, we address the segment which is known as application-specific integrated circuits, or ASICs for short, and system on chips, or SoCs, is another way that you'll see these high complexity devices being described. There are a lot of drivers for this market. and a lot of adoption amongst systems companies for having these ASICs or specific application-specific designs. If you think back to Apple, which was one of the first companies where this really became visible to the consumer, although ASICs themselves have been around since semiconductors started. If you think of Apple, they decided maybe 20 years ago that a way of getting good differentiation in the performance of their phones was to design their own chips rather than to use standard products. And as we know, that's done very well for them. So they use that capability. They design largely in-house, but some they outsource as well. And they use that capability to provide either better power consumption, so longer battery life, better graphics, better voice, better displays, whatever else it might be, better cameras is another good one for mobile phones. And they are able to do that because they have application-specific designs that are done especially for their own phones that are not available to anybody else. And many systems companies see this as a way of going ahead, and you are seeing more and more ASICs adopted by many of the big companies such as Amazon and Google, as well as the tier one automotives and even the automotive companies themselves. There are announcements from people like Ford, General Motors, Audi about having designs specifically for them rather than, again, use general purpose designs. One key trend to that and one key reason for that is shown in the graph embedded in the left-hand side of this chart, which talks about the cost per gate or cost per transistor. And up until about 10 years ago, what we saw was every couple of years a doubling in the number of transistors that are available in a particular chip size. So if you keep the size constant, the transistor count roughly doubles with each process technology. Again, you may well have heard of something called Moore's Law, which talks to this a little bit. About 10 years ago, the processes started to become much more complex, and what we had seen in the past, which is tied in with a doubling of the transistors, a reduction in the cost per transistor of about a factor of 2 as well. We saw that reduction in cost fall off. So let me just put that together. If every 2 years you're seeing a doubling of the transistor count, but a halving of the cost per transistor, then actually you see the chip cost stay flat. And that enabled the industry and enable customers to adopt new technologies. Once that cost reduction stops, as I say, from about 10 years ago, you're now starting to see the chips are becoming more expensive. You still get double the performance, but now the cost is going to double each couple of years. And of course, that's not sustainable. You can't go from a $20 to a $40 to an $80 to $160 chip without it becoming a real problem. So what we now need to do is we need to get more use out of every single transistor on a chip. And one way of doing that is making sure that the chips are designed specifically for your application, not for anyone else's. So you remove all the cost associated that you are maybe not using on yours. And at the same time, you're able to put some differentiation in. And that change in the cost profile is one of the reasons why ASICs are becoming so popular in the industry today, and why we're seeing ASIC growth, we believe, to be well above the general growth within semiconductors. Indeed, if you look at some of our competitors out there in the market who've been public for some time, you will see that their growth over the last few years has been very strong, both in terms of revenue growth and in terms of share price growth. There are other trends which drive the business apart from that particular one. There is the ongoing desire to get lower power, driven by all sorts of things, including many on the green agenda, and battery life as well being an important one. And then right now we also have big geopolitical trends, and many of you will have seen the CHIPS Act in the States putting $50 billion into semiconductors. There's a similar funding from the European governments going into 42 million euros into semiconductors. A lot about encouraging more manufacture and also more design in local regions within Europe and in the US. And we believe that as a company, we're extremely well placed to see the benefits of that. We are the only ASIC company operating in these high technologies that is based in Europe or in the US. And we think that we are seeing a number of customers come to us looking to secure their supply chains. We see this as a distinct advantage. And we see this as a big driver for our business going forward. more recently, we've also started to see some big technology restrictions being imposed on China from the US. And many of our competitors are very heavily invested in the China market. And again, we believe that these are going to cause big problems for our competitors. And we are able to make the most of those opportunities that we expect to see coming in the coming years. The next slide really just talks about Moore's law and just gives you an illustration of the sorts of complexities of the designs and the costs of the designs. And this is important from the point of view of looking at how scalable our business is. So back in the 1970s, we were looking at a couple of thousand transistors on a single design, and now we're looking at 50 billion or more. And of course, coupled with that huge complexity increase is also a big cost increase. In the top right, you'll see an estimate of costs associated with designing a chip. And you're looking at a new technology design costing, including software, $400 to $600 million to design. Now, we don't get involved in the application software, so you can ignore that half of the graph. But we are still looking at costs in the hundreds of $millions to design a chip from the ground up. And that means that we need to be able to reuse a lot of parts from previous designs to keep that under control. But it still means that the cost is increasing exponentially. Of course, that means that the revenue to us is increasing exponentially. It also creates a huge barrier to entry for newcomers who have not got the history and have not got the intellectual property available to allow that reuse from one design to the next. And as a result, you really don't see any new entries into the market for delivering these high-end new technology ASICs. Competitors. So if I take the whole ASIC market and divide it really into three, we're looking at really three categories of companies. We have very large semiconductor companies. These are companies that will provide standard products, but also application-specific designs. And companies such as NVIDIA, Broadcom, AMD, Marvell, and so on. These are very high-value contracts that they will engage with. There'll be variations on their standard products very often. You are looking at contracts, Broadcom, for example, recently in the press, talking about $1 billion ASIC contracts, so very, very large contracts. At the other end, you have companies which are working on older technologies, smaller designs, often very clever engineering. And Silica is an example, recently floated on the UK market of a company that's doing that type of work. These are typically mixed signal designs in older technologies. And we don't compete against these either ends of that. We compete in the middle market here with companies doing these very complex digital designs. And out of these 6 players that are working here, 3 we don't see. Very Silicon, for example, are heavily focused on China, Megachips in Japan, Faraday on another foundry that we don't work with. So our 3 competitors here making the majority of this market are Socionext, GUC, and Alchip, all 3 of whom are public. Socionext had an IPO in Japan very recently. So it does mean to see we're also able to see the types of numbers that they're doing, the revenue that they're doing, and the value that they're extracting from the production side of the designs. Now, these 3 companies have been delivering designs in production for a lot longer than we have. And it's the primary reason why you will see that their revenues and market caps are much higher than ours today. But in terms of technical capability, GUC as being, or Global Unichip as being the most well-known in the industry of those competitors, has about 4 times the number of staff that we can do, and you can see the revenues that they're doing. So we know that over time, as we get more and more of our designs into production, we know where we are heading. I'm not going to spend very long talking about barriers to entry. I'm sure you want to hear from Joe really about the financial model that we're working on. But as I've already said, we see very, very few people. In fact, we don't see any new companies moving into this market because of the difficulty of producing the capability to design high-end designs. If you want to, as a startup, design your own device, and some companies do, you're typically looking at maybe 200 million plus in venture funding to get your first chip into market. So these are the sorts of sums that people have to invest. And it's a reason why companies are so keen on outsourcing this as a function. Even the very large companies often balk from trying to bring this in-house. Audi recently announced that they were going to be working with ST on outsourcing ASICs, for example. Some companies do acquire the technology through other parties. Then you're looking at maybe acquiring an existing company with the technology. But again, Amazon paid nearly $1 billion to bring that technology and that capability in-house. So very, very high barriers to entry here. Let me do what I just said and hand over to Joe. He's going to talk you through the business model a little bit and the financials.
Good, thank you. So these next couple of slides are aiming to answer two questions. One, what are the main revenue drivers behind the business? And two, why is the business scalable? So answering the second question, why is the business scalable? If we look at this illustration, we have about 13 designs showing if we assume for a second that the three at the bottom, which are shown as auto, edge, AI, and mobile, use up all our engineering capacity. We have more than 3 designs in play, but for the purposes of this illustration, we'll just pick those 3. And the design phase is the dark blue phase. Then what this is trying to show is that we can only work on 3 designs at any point in time. So design number 4 can't start until the mobile design has started. And historically, as a design engineering business, that's indeed what would happen, at which point all revenue from the mobile project would end. But as an ASIC business model, all that's happened is that we've transitioned to a different phase in the program. So design phase has ended, and we're now in the prototyping phase, which allows the design engineers to move on to the next project whilst the mobile project continues. And then thereafter, it will move to the supply chain. And that supply chain, as Graham mentioned at the beginning, is potentially 3 to 10 years, depending on the chip that's involved. And the key to this is that the design phase is very headcount intensive, but the prototype phase and the supply chain phase only requires a fraction of the headcount. So therefore, as a design consultancy business, the business was historically always constrained by the number of engineers, but under an ASIC business, we are no longer under that constraint. And what we've created is a reoccurring revenue stream based on the customer's reordering of chips for their product. So that's not under our control. It's all down to their business model and how many chips they sell. But our business model is not a license or royalty. We are selling the complete chip to the customer, and we get the full revenue for that. So where are we as a business? Well, if we look at the mobile phase, well, we are just about to complete the design of that mobile project, and we're moving into the prototype phase before the end of this year. And we'll be moving into the production phase at the end of next year. So we're about a year away from production on the mobile chip. The Edge AI also moves into prototype phase at the end of this year, and production is going to be towards the end of 23, beginning of 24. Whilst the auto project is moving into prototype in the summer of next year, and production is scheduled for much later because that's a much more complicated chip. So we've just been talking about aggregation of revenues. In other words, why the business can scale its revenues. But that's not the only revenue driver. And here we're looking at all of them. So starting at the bottom, we have the design phase. The design phase is driven by headcount. Sondrel has grown at roughly 20% compound growth every year, based solely on its design. We will increase our number of engineers. Designs are becoming more complex. They need more engineers, and therefore our design revenues will always rise. And there's no reason to expect them to not to be 20% going forward, at least. Then we have IP. Those are the scalable building blocks. As we are working in the more advanced geometries, those scalable business blocks become very, very expensive. For example, a CPU can easily be $1 million on its own. So therefore, that is procured by us and recharged as part of the project value with an appropriate profit element associated with it. The NPI phase, which is the prototyping phase, you can see here that is quite significant, and that's because the production costs associated with the advanced geometries is rising dramatically. So to put that into perspective, a 40 nanometer mask set, the mask set being the tool that prints the chips, would be a few $100,000, whilst a 5 nanometer mask set, where we are working at the moment, is $10 million. So you can see quite clearly that there's going to be a significant revenue increase associated with that. And then you have the scalability of the production volumes. So where are we as a business? Well, we can say in this illustration that we're at the beginning of the light blue phase. In other words, we're at the beginning of the NPI phase. And based on that, our revenues per head are £80,000 approximately. By the end of next year, we'll be at the beginning of the production phase. But if you look at our competitors, who are effectively on the right-hand side of this chart, they're generating £600,000 per head compared to our £80,000. So you can see the trajectory that we're on, and we're following exactly the same business model as they have. Main difference, they've been doing this for many years already. So having talked about the business model and where our revenues are going to be increasing, we should just look at where we have been over the last few years. So up until 2019, which is our last normal pre-COVID trading year, we have been growing at 20% compound growth, good profitability, good cash flow positivity, and as Graham mentioned at the beginning, from 2017, we've been building our commercial capabilities in the ASIC business model. So we had established US offices, US sales teams, increased our R&D spend, increased our marketing spend. Coming into 2020, we were full of confidence. We had a pipeline of business that had risen from what historically had been 20 million to 200 million. We were about to sign significant automotive ASIC contracts, and then the pandemic arrived. And the very first thing that happened was that all new business was put on pause as the world took a breath to understand what was going to happen. Now, combine that with projects naturally coming to an end in 2020, we quickly saw that our revenues would start to fall away and we would have excess engineering capacity. So we took that opportunity to redirect our engineering teams into our internal R&D. We do not capitalize R&D, so the losses in 2020 and 2021 reflect all the R&D that we've been carrying out. So that we were left with a very flat second half of 2020 and a very flat first half of 2021. But the market came back to us in the second half of 2021, where we signed 3 major ASIC contracts. We began to execute those ASIC contracts right at the end of the year. So you're not seeing the revenues in 2021, they're really flowing into 22, 23 and beyond. And you can see that because in the first half year results, we've already achieved last year's revenue We've also signed another automotive ASIC contract within 2022, and our revenues are increasing month on month. So the real story here is our growth was stalled during the pandemic, as so many businesses suffered. There is no doubt that that cut lasted longer than we expected to, and definitely cost us a lot more than we expected to. But it has meant that we've come out of the pandemic much more strongly able to take advantage of the marketplace, and we have proven that by closing major contracts and starting to execute those. In terms of cash flow, up until 2019, we were cash flow positive and we were paying off debt as a result, and you can see that on the financing line. Through 2020 and 21, of course, working capital came under significant pressure. We had tremendous stakeholder support. So we have a shareholder loan from Siemens, and they agreed to suspend all loan repayments. We took financing from our bank, and we have good support from our key vendors who are all the way through that period. We work very closely with all stakeholders too, and they all understood our trajectory, what we're trying to achieve, and the market opportunity. And if you look at 2022, you can see we're cash flow positive. And that's as we would expect it to be, because as we close new projects are cash flow positive in the way they're structured, and that's reflected in the 22 numbers. Balance sheet, well, there's a lot of numbers on this balance sheet. I'm not going to go through all of those, but I am going to draw your attention to just a few. Top line, intangible assets. I've already mentioned we do not capitalize R&D. So what is the intangible assets? So we have entered into long-term framework agreements to procure design tools from our vendors. These tools are very expensive. They're very difficult to procure in volume. But by entering into a multi-year agreement, we've generated the ability to have as many tools as we require for our engineering. Under accounting rules, we have to bring the full value of that contract on as an asset. And then further down, under the long-term liabilities, we have to bring on the full value of that liability. And that's just amortized as we use it over the period. But overall, when you look at the balance sheet, it's very much a balance sheet that you would expect for a business that has lost 40% of its revenues over the last 2 years, but has continued to invest in the future through R&D expenditure. So one of the purposes of the IPO was to bolster the balance sheet, and we've successfully achieved that. And the reason for doing so is the future is leading us towards more larger customers, and those larger customers clearly are going to be working with us for much longer periods. The design phase of 18 months is now becoming an engagement of 10 years potentially. So therefore they need to have the confidence to know that we have the financial strength to last throughout that period. Pass you back to Graham.
Okay, so just in summary then, we are, as we've said already, a UK headquartered fabless semiconductor business. We hope that by coming back to the public markets that we can really start to create some more excitement around semiconductors. Certainly, we are very pleased with the way our business has grown over the last 20 years and feel that the public market exposure that we're getting and the investment that we're getting is really going to help us to accelerate well beyond the historical growth rates. We're very unusual in the market. We only, as we said earlier on, have around about 3 competitors that we see on a regular basis. They are all based in Asia. our proximity to our customers and our ability to shorten the supply chain for them, we see as a distinct advantage right now. And I think that is being very much validated by a very, very strong new orders pipeline, bookings pipeline, a lot of interest that we have, strong visibility of our revenue going forward, and good first half numbers. And when the research is initiated in a few weeks' time, I think you'll start to see some very interesting proposals coming out of that, and I hope you enjoy reading that when it comes out. Okay, we do have some questions. We'd like to move on to the questions. If you have further questions, please do type them in.
Graham, Joe, if I could just jump in and say thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Graham, Joe, as you can see, received a number of questions throughout today's presentation, and if I could just ask you to read out the questions and give responses where it is appropriate to do so, I'll pick up from you both at the end.
Good, thank you. Sandra, as you can tell, this is our first presentation in this manner, so we're a little bit learning on the job, and I clearly got that a bit wrong and should have had a break there, but thank you. First question is, where do you see the company in 5 to 8 months' time? Well, I think we have a very strong outlook here, and as I say, you'll see more details of that when Cencast initiate their coverage in a few weeks' time. And we're very optimistic, of course, about the future. And if we look forward maybe 5 to 8 years, again, you can see by looking at some of our current competitors, the type of targets that we're aiming for. The business is very strong. The short-term turn down in semiconductors is not impacting our business at all, and we do not expect it to. This is as part of the cycle that we are very used to riding through over the last 30 years that certainly I've been in the industry. So we are very optimistic about the next few months. The second question is, how do you mitigate the risks? Sorry, can you expand on the competitive landscape and where you feel you differentiate from others? Yes, so we are very aware of our competitors. With only having a handful, it means that we get to know them very well. We have been competing with them in winning customers for the last 10 years. We know very well the areas that they are good at, and we know the very areas where we are good at and where we feel that we can win. And part of our sales cycle is very important to select the customers that with the right volume potential, and also where we know we can compete. Our primary competitors, 2 of our primary competitors are active in high-performance computing much more than we are, 1 more in automotive. We tend to operate a lot in the automotive and the vision spaces, so we see them very well. But of course, it's important that we do understand our differentiation. How do you mitigate the risks to supply chain pressures, given you offer a full turnkey service? Well, actually, this is one reason, of course, this has been in the press a lot recently, but it is one reason why people do come to us rather than try to do things themselves, because understanding supply chain, understanding where to keep inventory, understanding how to order and how to forecast, and also the ability to amortize forecasts across multiple customers are all the things that we have to be good at in our business. It is something that many of the management team here have been doing for a long time. Our head of operations, for example, until very recently was running the European operations and marketing teams for TSMC. So the other side of the fence, if you like, understands very well the difficulties of allocation from the other side and how to manage those. So many of us here in the management team have been doing this for a long time. The companies that in particular have been caught out recently by the supply chain pressures have been more those that are looking at the just-in-time type of arrangement with semiconductors, which does not work particularly well. So making sure that we have good forecasts, making sure that we are able to commit to our forecasts always, that we can manage that. What KPIs should we use to measure your performance? We'll be saying more about that in the coming months as exactly we do that. And in particular, as we produce our first earnings update around about the end of this year, we'll be talking more about how we see those KPIs. I think as a basis, probably the best starting point is to look at what our competitors are doing, what GUC and what Alchip in particular are doing. We will be doing things similar to those, but more tuned to our particular areas of market and our particular stage as a business. You referenced design partnerships with ARM, Samsung, etc. What benefits does this bring, i.e. work referral? Yes, it does indeed bring a lot of benefits. The first benefit it brings is if you like, an endorsement of our capability. So since we established the first one of those design partnerships, and you'll see our names on their websites, people stopped questioning whether or not we were capable of doing the job. So these endorsements are difficult to win. They involve a lot of often multi-year engagements across a number of designs. If you look at TSMC, for example, they flew people over from Taiwan to audit us. And our customers take these as very strong endorsements of our capability, apart from the reputation that we have in the field. We also work closely, so by being a trusted partner for they, we do get a lot of referrals. We've had a lot of referrals from many of these companies for new business. And again, that is very important to us and something that we put a lot of effort back into. And we create very much a win-win. If you look at any one of those companies, ARM, Samsung, TSMC, they are only part of the customer solution, whereas we're a much bigger part. So our customers want to buy from us and they want to use microprocessors from ARM, they want to use the foundry process, the silicon from TSMC or etc. But we're very much bringing it together, understanding what it is that is going to drive our customers' business and helping them to get the right solution. So all our partners that we work with are very important to us. The question here, I read you've been loss-making for the last few years. Is that true? And when do you expect to turn a profit? So I think that Joe has been through the P&L with you. You will see that we are moving into profitability right now, back from a position where we were being consistently profitable over the 20 years of the business. I mean, we have been, the IPO was our first major investment round. So we have been profitable through pretty well all of those 20 years of existence. I think one thing that we do know is how to run a company profitably. We are not planning on running at a loss for long term in the future. How many other companies can design down to 5 nanometers like Sondrel? Really, the competitors that we saw on that sheet, just those half a dozen companies offer these services, plus the very large semiconductor companies that were in the top part of the competitor sheet. Companies like NVIDIA and Broadcom, of course, can also do it. But if you are looking to get a chip designed for your application, then it really is just a handful of companies that you are likely to come to. The intellectual property that's needed to design a chip, as well as the number of people that you need, the processes, the project management and schemes that are needed to do this are very difficult to gain. Can a client just use Sondrel for its design and go elsewhere for prototyping and production, or is everything offered as a package? Everything is offered as a package. So although we can take on some engineering only engagements, these are for specific reasons. This might be because we are working with our partners, for example. So one of the partners comes to us and says they have a customer who's got a particular need and some help in their project. We will engage with that and we will support our partners. There are some projects that we engage with that are long-term, very high performance designs that we will continue to engage with. But the vast majority of our new engagements today, the customers are obliged to stay with us through the prototyping and production phases. Tied to that is how much bigger are production revenues versus the design and prototyping. It does vary a lot, but typically we are looking at design your own calculations from that, but typically maybe 5 times. It does depend on the application, and it's important for us to engage with customers where we really do have good long-term lifetimes and high values in production as well, because as you can see from some of the numbers Joe talked about, leveraging that volume production value is important to us to drive business forward in the future and really to give us a lot of scalability. How have recent US chip laws affected Sondrel? For our business, not at all. We do have an office and a design center in China. Today, it is only a small part of our business, so it is not impacted at all by the US chip laws. However, our competitors are, and we do see that particularly the Taiwanese-based competitors are heavily, they have a large proportion of their business, I should say, selling into China, selling into high-performance markets and high-performance applications. And we do believe that this is going to cause our competitors a challenge going forward. And as a result, this will provide us with an opportunity. Do you think US growth will play an important part of the growth strategy? Yes, absolutely. One of the primary focuses for us and use of proceeds from the IPO is to grow our US team. We are looking to grow that significantly over the next few years. And that is a market which is much bigger. Although we do have some US customers, the US ASIC market is maybe 5 or 6 times as large as the European market. And in these high-end performance designs, maybe even higher. So we see it as a huge market opportunity for us, and we will be investing heavily in that over the coming months. I'm going to let Joe answer the next question because it's a financial question and he hasn't said anything. So let me.
So the question is, does your gross profit differ by revenue type, design, prototyping, etc.? If so, to what extent? So yes, it absolutely does. As you'd expect, the design being primarily headcount, there's a high gross profit associated with that, typically anywhere between 50 or 60%. During the prototyping and production phases, that is mainly outsourced, so it's third-party costs. The margin is considerably lower on those elements, but the values can be much more significant. So, for example, I mentioned that a mask set might be 10 million on its own. That would be, you would expect the design cost to be a lot less than 10 million. So although the profit margin is less, the absolute more significant. And when it comes to production, of course, we're talking potentially 5-10 times the design cost, design revenue coming from production. So over time, not only do we build a reoccurring revenue stream, we're also building that at quite a high profit in terms of absolute number.
Graham, Joe, thank you very much for that. I think you actually managed to address all the questions from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Graham, could I just ask you for a few closing comments?
Yes, thank you. It's good to get this opportunity to talk to everybody. As I mentioned earlier on, it's also very exciting for us to come back to the market and to become a public company in the UK. There are not very many, well, there aren't any semiconductor companies in the UK of any substantial size. For sure, our IPO, apart from being one of the biggest this year, if not the biggest this year on AIM, is also the biggest for maybe 20 years on the UK market for semiconductor companies. And many of those we've done in the past are companies like ARM and CSR that did really well. And we would like to very much replicate those and be the next ones. And we see we have a great opportunity here. We have some fantastic customers. We have a very high level of repeat business. In fact, more than 70% of our business is repeat business. underpinned by some great partnerships with all the leading companies that you'll see along the bottom of this screen here, who are all supporting us in this. So we think we have a fantastic opportunity. It's an exciting market. Semiconductors is pervasive and it's in everything we use today. And we see no sign of that changing. If anything, as we get more artificial intelligence, more visual systems, as people insist on sending video amongst themselves, as television definitions and picture definitions become more and higher definition over time. So we think it's a really exciting time in semiconductors, and we're looking forward to being a part of that and really doing something great on the public market here, and hope that you will join us.
Graham, Joe, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Sondrel Holdings PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.